Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Puneet Javeri, and we're going to today talk about an auto company which is guiding for 20% sustainable growth, or rather, let me change that a bit, tweak that a bit. They're talking about 2x the growth of their industry, and it's on a very small base. They're tapping into export as well. So all of that likely to aid the numbers overall. But let me start off with what I want to know with regard to SJS Enterprises. Very, very strong clip of growth is what they're guiding for. I want to know whether they're doing the 20% sustainably is what one can expect over the next 5 years. The second piece is with regard to Walter Pack. Now this has been, this acquisition has dragged the business a little bit where Q1 FY26 is concerned. I want to know, and that's because of client concentration. I want to know whether that can turn a corner and how quickly can it do that. The third piece is with regard to client concentration. Is there a thought process within the company to acknowledge that and to change that is what I'd want to understand. Fourth one is with regard to margins. They do 26% margins, so high growth clip plus high margin plus a unique business. It meets all of those parameters. I want to understand whether those margins can be maintained and what the downside risk could that well be. Fifth piece is with regard to growth. Where will it come from? Current client cohort or a change in product mix or a little bit of both? I'd want to try and understand some of those levers. Sixth piece is with regard to competition and moats. And I'm rushing through this because we've already done the interview. It's a long one and we want to make sure that you listen to the entire interview. So that's the sixth piece. The seventh piece is with regard to capex and revenue visibility. How much of capex is getting penciled in and how much can the top line go to given this capex? So no future capex till what point in terms of top line? All of that and more on KYC today. Let me start off with about the company. What it does, it designs, develops, manufactures decorative parts for vehicles and appliances. I'm going to quickly tell you briefly what it means. Your car dashboard, on it there is of course the speedometer. They manufacture that part of the car. They manufacture the glass on top of it. So all of those parts. Your steering wheel has the logo of the car on it. So does your two-wheeler, and therefore all of that is what they typically manufacture. Logos, overlays, dials, all of these. And it's a fast evolving business because if you see some of the new age cars which are coming through and some of the more expensive ones, the higher ticket ones, they have digital logos as well. So all of that is what they've pivoted to. In terms of product categories, that's quickly coming up on your screen. It has decals, graphics, 2D dials, 3D dials, which is typically a display on the car and the branding on the vehicle. Domes and 3D badges, overlays, which is typically your logos, different types of logos both in 3D as well as in 2D, aluminium badges and in-mold parts, which is high quality, durable branded parts within a vehicle on the appliances of the vehicle, giving it its nice shape, or the branding inside the car. All of that is taken care of. Optical plastics and cover glass, which is lots of glasses all around the car as well as on your other appliances. I'm restricting this to cars, but they also do other appliances, and that's a fast growing piece. So for example, your two-wheeler, on top of the dial you'll have the glass, which is what some of this is. The lens mask is typically the mask on top of, say for example, your headlight on the car or the bike. The mask on top of it, which is a transparent plastic mask, is also manufactured by them. Chrome plated, painted parts on the exteriors, handles, etc. All of that is taken care of by them. The aftermarket transformation. Now, this is a large market. We've come to acknowledge it. And the aftermarket, there are a lot of customers looking to transform their vehicles, make it look newer, jazzier, cooler. All of that is taken care of by them, and illuminated logos. I did speak about that. The revenue mix quickly coming up on your screen. Two-wheelers is around 39%, currently was at 34% in FY25. Passenger vehicles around the 37 to 40% number. Consumer is around 18 to 20%, and others is around 6% odd. That's the broad breakup of the revenue. The geographic mix, currently domestic is around 92%, 2% with exports of around 8%. Exports expected to double in terms of overall mix in the next few years is what they're targeting. They're targeting a 15% export number very, very quickly. Now, let me allow Puneet to start off with the income statement in terms of the metrics.
Well, definitely. It's been a very strong performance by the company over the last 3 to 4 years. From FY22, the revenue has grown at 27% CAGR, and that's passed on to the margins as well. Over 26 to 27% is what they've done in this particular time frame. Profits subsequently have grown at 28%. So this acoustic as well as aesthetic products that they manufacture for automobiles has been working very well, essentially with the premiumization of this particular space, and that's visible in the company's numbers as well. So there's no doubt it is a big thumbs up given on this particular metric. Balance sheet, Harsh.
So equity, quite decent in terms of its size, 680 crore, fast growing because it's extremely profitable in the sense it's got a strong profitability. Also, it's trading at around 6 times book value, so something to be taken care of, but very, very low to no borrowing. Your cash bank balance is also decent. There's some capex in the pipeline. We'll speak about that with the management. Cash flow, Puneet.
Well, again, cash flow, we spoke about the profits that subsequently almost doubled in the last 3 years. The cash flow from operations also has gone from 87 crore all the way up to 163 crores in FY25. We've seen the cash flow to profitability or ratio as well on your screen right now doing very well. While net cash flow, while lower, has been lower because of the investments that they've done over the last few years. They've also done roughly about 45 crores of capex. They're expecting to do that in FY26, but that largely seems to be investing for the future. So we've given this a thumbs up as well based on the company's future outlook, as well as the efficiency with investments, which is showcasing in the numbers as well.
Excellent. Let's talk about return ratios, and you see that above the 20% mark, no questions asked, and therefore a thumbs up. It's a sustainable 20% given that there is some bit of confidence with regard to margins, and if that continues, top line growth margins, well, no reason why this should not be sustainable. Shareholding, Puneet.
Now, shareholding has largely been stable from the promoter family. We've seen from roughly about March of 24 when they've held 21.8% stake. We've just seen in the previous year that private equity firm Everstone had actually sold roughly 29 to 30% of their shareholding. So you see the promoter holding has actually gone down from 50% to 21%, but that's largely the exit of the private equity investor. Promoter family continues to have confidence in the business. We've also seen subsequently this selling by the PE fund lapped up by foreign investors. Roughly from 5%, they've gone to 17% in terms of their shareholding, while the investors, roughly 1/3, remains with the general public as well. So keeping an eye on these niche businesses has been one of the key aspects of individual investors, and that seems to be visible in the numbers as well.
Street cred, you look at a 12% 1 month return, 60% 6 months, year to date is 21%, and 1 year is 38%. Since November 2021, since listing, it's a 3-bagger for investors. Clearly a thumbs up, no concerns here. Puneet, I'll allow you to take both valuations and coverage.
Well, let's start with street coverage first. It has 8 buy calls and none of them are hold. The other key aspect is that currently, out of the 8, we've picked out a few brokerages like JM Financial, Elara, as well as IFL. These were some of the ones which were very well known to the street as well. All of these have a very positive outlook on the company. Roughly the target price ranging from 1400 all the way up to 1700. For Elara, they've actually raised that post Q1 earnings as well, which was in the end of July. So it is a positive outlook on the company, and you'll hear from them as well. In terms of valuation, while there is not so much comparison available in terms of listed players, because the company also mentions that this is a very wide industry. A lot of players do a lot of smaller aspects of the business, but with SJS largely organizing it and getting it under one umbrella, that seems to be one of the company's moats, and currently trading at over 34 to 35 times price to earnings. For FY26, based on the coverage from the analysts, it trades at roughly around 28 to 29 times price to earnings. And while there are much more established players amongst the auto ancillary space that trade at similar valuation, the lack of any one particular company with this kind of segments as well as granularity seems to be why Street is giving this kind of valuation to a company sub 5,000 crores in terms of market cap. But hence, we've given this a neutral on that aspect, but it's definitely positive on the growth the company is projecting.
Excellent. Let's therefore stack up all of the rating parameters, and it gives us a very, very healthy 6.5 out of 8 on our KYC ratings. We spoke with Sanjay Thapar, both Puneet and myself, the Group CEO and ED at SJS Enterprises, listening to that entire conversation. Sir, you've guided for very strong growth. FY26, yes, you've given that guidance of 20%. So I'm trying to understand a slightly more long-term perspective here. For how long can you continue to grow at this kind of clip? Because as your base grows as well, and you're growing at nearly twice the industry, can you continue to clock this 20% kind of growth clip is what I want to understand first off.
Let me put this a little bit in perspective. So the global market for aesthetic decorative products is close to about $4.7 billion. And at SJS, we've historically, over the last 3 years, we have a revenue CAGR of close to 27.2%, which means that we've outperformed the underlying industry by a factor of 2x or more than 2x actually. The industry in the same period has grown just 10.5% if I combine the volumes of two-wheelers and four-wheelers put together. So we are quite hopeful that because of the trend of premiumization, our focus on new products and new technologies, which are higher in value and higher in value add, we will continue to grow around the same clip. So that's what my expectation is.
Oh, so would 5 years be the right kind of view or visibility to take in terms of this 20% growth guidance? Can we pencil in that next 5 years at least the 20% growth clip will continue at the very least?
We don't guide in terms of percentages. So what we say is that there's an underlying industry that we will outperform. So our guidance for the current year was that we will be 2x of the industry growth, and we'll continue doing that. So think of us as a high growth, high profit company, which is still tapping the opportunity set globally. So we've positioned ourselves as a global supplier, and we are very excited about the opportunities that lie ahead of us.
Mr. Thapar, very good morning to you. Thanks so much for joining in. It's Puneet this side. We spoke recently post our Q1 earnings as well, and largely you seem to be quite positive with the acquisition of Walterpack as well as your consumer business as well. Given that you are outperforming the industry, roughly at about 760 odd crores for FY25 in terms of revenue, could we anticipate that this could lead to almost doubling in the next 3 to 4 years, given the new products that you integrated are still to see a bigger impact in your existing businesses? So could that be a fair assumption given the strong margin profile as well?
I think that's a fair assumption. So I'd be disappointed personally if we don't double our sales in that period of time. So yes, directionally, you are absolutely right.
And Mr. Thapar, essentially in terms of growth, it's quite obvious that you are outperforming the industry. Just talk a little bit about Walterpack as well as the consumer business, because your auto business is growing at a fair click, and that's well known. With chrome plasting as well as something that you've spoken about is a very big business, as well as with the export opportunity. Which business do you think will lead the growth for you specifically? Is it these two new verticals that you expect? And what is the expectation of some that you can quantify for the consumer business as well? What can we look at?
Look, the way we look at ourselves in terms of a growth opportunity is through the lens of the customer. So what does the customer want from a global supplier? He wants a company that can offer him the best-in-class products at a cost that is very competitive and with no delivery hiccups. So over the years, we've proven a supply chain capability. I export to more than 220 locations across 22 countries, whether it was COVID, whether it was the container blockage. So we've earned that trust. So that makes us very confident that we are a company who's recognized by marquee OEMs across segments, whether it is automotive, whether it is consumer. So we've grown well, and we have a track record of growing large mega accounts. Coming back to Walterpack, so I think that is a game changer as far as us. So we've, with that acquisition, created a capability set that we lacked at SJS, both in terms of tooling for complex in-mold formed parts, also some specialized know-how in terms of 2K molding, and that is a carrier. Think of it as a force multiplier for SJS, because we have a very strong printing background, printing on different substrates. And with this acquisition, we've actually, what we've done is we've created a very niche set of components. And Walter Pack is one of the very few suppliers, Walter Pack Spain I talk of, is one of the very few suppliers globally in this area of in-mold formed decoration parts. And with this acquisition, I think we are at the forefront in terms of technology. These are expensive parts, but we see the trend of premiumization that happens in India. So typically you launch high-end expensive parts in premium top-end segment of vehicles. Slowly customer demand for such aesthetics percolates down to the mid segment and the entry segment. And we see the market growing very rapidly once that happens. So we are, I think, strategically in a very good position as far as Walter Pack goes, both in terms of technology. This is a long lead item because tooling is very complex. It takes close to about 8-9 months to make a tool. So I would say in the period of 4-5 years, you should see significant contribution coming from the in-mold form parts. We see a lot of demand for chrome plating, especially in the export markets. So we could possibly see a lot of business growth in that area as well. And largely to say, what are the growth drivers? So four-wheelers as a business segment will grow very rapidly for us, as will consumer businesses, thanks to the new technologies that we are launching.
Mr. Thapar, on Walter Pack, Q1 was a slightly softer quarter. When do you start to see recovery there? Of course, reasons well known, there's some bit of drag coming in with regard to clients. When do you see a recovery there in terms of your top line? And what does Walter Pack do to your margins? Are you able to maintain that 25-26% kind of margin number?
I think we've proven that. So historically, we've maintained margins north of 25%. So 25-26% is what historically we've delivered. Maybe 3 years or 5 years now, and after the acquisition of Walter Pack as well. So I think the truth lies in the numbers. So Walter Pack is an important component to our overall strategy. Where do we see? So since this was an acquired business, there's a legacy set of customers that we have. So as a company, we de-risk ourselves by saying we should not be too dependent on one single customer. So in fact, consolidated basis, no customer constitutes more than 15% of my top line. But that is not true for these subsidiaries that we have. These are basically acquisitions. So there is a legacy set of customers. So we are fast gaining traction with other customers as well. And I expect that balance of customer concentration should also reduce over time. And we already have good visibility for orders that are coming in. But as I said earlier, Walter Pack parts are large in-mold form parts which require tooling time. So I would imagine that over the next 1 year or so, we should see Walter Pack coming back and it being a more diversified play, reducing the customer concentration that we currently have.
Mr. Thapar, one question on your kit value specifically, because we've spoken about this in the past. You were at somewhere around 1,200 to 1,500 for passenger vehicles. You've now gone to roughly between 4,000 to 5,000 post Walter Pack's acquisition. Now, you've had some huge guidance. You're mentioning that this will double in the next 3 to 4 years. Could you specify if this will be done via new products like cover glass amongst others? Or will this be with increasing your current business with your current clients, the top 7 to 8 that you cater to? So where should the growth come from?
So growth comes from both these areas that you mentioned. So yes, displays continue to be a very strong opportunity set. SJS is well poised to address this market because of our inherent nature of the products that we've done for a number of years. So aesthetic parts, and cover glass is also an aesthetic part that requires printing. And we are in the process of examining what more can we do in the cover glass business. So we don't want to restrict ourselves to cover glass. The overall displays as a category is very interesting for us. And we are positioning ourselves to address that market. The kit value that you mentioned, you're right, from 5,500 odd rupees potentially per four-wheeler. it is likely to go up to 10,000 per vehicle over the next 3 to 4 years. And SJS is, I think, strategically absolutely in the right direction.
And Mr. Thapar, just a follow-up, what would be, the kind of addition that you think that cover glass could do to your products? Is it one of the most game-changing aspects? Because it seems to be that your current products are adding a lot of value, but this one is a high, the price of that per vehicle is also high and the margins are also better. So what kind of addition do you think that could get you?
So my guidance really is that we continue adding new products. So cover glass is one, in-molded electronics is another area that we are working on. So all these are new technologies. At the moment, there's nobody who makes cover glass in India. So as we move forward, I think we will have an early mover advantage, and they will continue to deliver revenues for us. But our revenue growth, even in the other lines of businesses, are very strong. So we have a great opportunity for cross-selling. So every time that I order new customer, I have maybe 14 different product technologies that I can offer to them. So our ramp up is pretty rapid. And every time that we acquire a new customer location, so there's a lot of opportunity for growth. So where the growth will come from will be both. This cover glass business and display-related businesses will grow, as will our other product lines that we've created over the past years. So it's a secular growth. But as I said earlier, automotive four-wheelers are likely to drive growth because they're larger products and larger cover glass, larger everything. So both interior and exterior. So that's a great area that we've pivoted to. So maybe 5-6 years ago in 2019, 70% of my sales came from two-wheelers, which we've successfully transformed, and now it's equal weight. So maybe 35-36% from two-wheelers and 35-36% from four-wheelers. So I think I'm quite happy with the way we've been able to pivot the company.
So where does this go in the next 3 years? Do you continue to add product lines, and therefore that will not only expand your market share within this segment, but also allow you to capture market share in other segments? Is that how one should think of SJS?
Yeah, our products are fairly agnostic to the end use. So typically if you have a treadmill, that requires overlay we make. So those are the markets that we've not addressed yet. But growth will come across all segments. So it's hard to call out any one area, but broadly, appliances and four-wheelers will drive growth for us, especially in the export markets. India, of course, we continue to retain our position and consolidate our market position.
Mr. Thapar, just one final question from my side. Essentially for two-wheelers as well, you mentioned that the share has gone down from roughly 70% in 2019. You are adding new clients. You've added Hero in the last couple of quarters. Could you just give us some sense of the competitive intensity in this space? Because it's a high volume product. We're also expecting some kind of cost increases because of ABS. So what does that do for you, for example, in terms of the cost increasing essentially? So what is the current conversation that you're having with clients, and who are you actually competing with? Because for the first time you've gotten Hero, and Hero sells over 50 lakh motorbikes. So just some sense on that sense as well.
No, so let me correct you. Our two-wheeler business has not come down. It has increased.
The share of course, four-wheelers has also increased. Understood, sir. The overall revenue.
Businesses have grown tremendously, so therefore that weight has come down. So that's the point. Yes, we are very optimistic about Hero, so that's a good addition to our portfolio. And we continue to develop new models for them. And as I've stated earlier, we would potentially look to consolidate and gain a significant market share with that, as is our endeavor with all customers. So coming back to ABS does not impact us really, because what we do are PVC films and special materials for their logos. So there is not much of a challenge in terms of ABS, because we don't do plain vanilla molding. The business that we are in is high value add decorative products that are long lasting. And that is what is our DNA as a company. And that translates into, it's a very complex business, batch mode operation. So competition intensity is extremely difficult. So there is, I don't know of a single company in India or overseas which has as many products as I have in my portfolio. So we have close to about 14 different technologies, and most of the competitors that we have focus on just one or two. And I think what helps us with that is to position ourselves as the supplier to go to when a designer looks at improving aesthetics in a vehicle. So they're happy to do that. We have a styling studio which designers come and work along with our designers to formulate specs. And we do this pro bono. So we also have rapid prototyping capability. So we supply products with a very short turnaround time, and that I think engages us even more deeply with our customers.
Well, he also spoke about capex, and he said that capex, which is in the pipeline over the next 2 years, will take their top line from the current sub 800 crore to 1400 crore nearly. So that's broadly the guidance. But that's all the time we have from Puneet, myself, and everyone who puts this show together. Thanks so much for watching. Hope you found it productive. Of course, stay with us on NDTV Profit.